Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the programme where you can have all your property related questions answered by our team of property experts. Joining us by Zoom we have Andy Wood, tax expert, barrister and founder of ETC Tax. In the studio we have Kam Dovedi, property investment expert, mentor and founder of Premier Property. Right, well we'll get straight on with the questioning and we'll go first to you, Kam. I'm about to buy my first property and am naturally being cautious and am researching historical prices to make sure I do not make a mistake. I was surprised to learn through checking the property portals that the property I've chosen, which incidentally is around 12 years old, has risen only marginally in price during that period since its original sale and purchase. Can the panel advise me on the importance of this figure? Does it mean that there's something wrong with the property, or should I just go ahead if the property simply suits me?
Yeah, that's a really good question there. So in terms of purchasing property, in my experience, what we look for is first of all something that we can add value to. So in terms of adding value and also being able to get some form of discount right at the beginning. So what I'm saying there is, of course, everything sells at market value. However, you're looking for that slight edge where you're able to buy wholesale, some discount to properties on that street. So by buying at some form of discount and adding value, what you'll find is that you can really get that property to appreciate its value itself amongst other properties on that street. So in effect, what you've done is you've built in a discount. Now, when you do it like this, it's really about thinking of it as a business, because it is a business. Whether it's your first one or your second one or your 100th one, doesn't matter. It's still a business. So when you put these business principles into place, what you'll find is that you will find that your properties have actually appreciated in real terms because you've built that equity in there.
Okay. And
also another way is that you can actually buy properties where you look at the potential for adding extra value, such as planning gain strategies, for example, permitted development or development, extensions, that kind of thing, which will add some value as well. So it's about looking at that. That's probably the reason why that hasn't happened. But you can't go in the past, you've got to go forward, isn't it?
Okay. But so if you look on one of the portals and you check the purchase price 12 years ago, you find it hasn't gone up much, does that indicate to you an issue with the property?
Well, usually, we don't know the specifics of this particular deal, but usually it's from new builds. So if it was a new build, for example, compared to secondary stock, typically a new build is like, think of it like if you use the metaphor or analogy of a car. So you buy a new car, you drive it off of the showroom, and as soon as you've driven it off, the value of that car has diminished straight away. So if we kind of relate that to property, in the same way, a new build, when you're purchasing a new build, now remember, creating a new build is different. We're talking about purchasing a new build. So if you're purchasing a new build compared to secondary stock, such as Victorian or Georgian, whatever it is, then you'll find that the new build loses its value in the first 4 years. And there's a lot of data behind this. And listeners to this, watching this, can check the data. You'll find that for the first 4 years, the price of the new build will tend to fall in line with the secondary stock. So that could be another reason.
Okay. And also, presumably, the developer is quite adept at selling at the very top price in the market at the time.
Absolutely, there's that. Yeah, absolutely, there's that. So hence, what would you like to be? Would you like to be the buyer of that, or would you like to be the developer? Another thing, if someone wants to do that, there's another thing to think about.
Having spent a life in property development, I think I know which side I'd prefer to be on. But all right, Kam, thank you very much for that. Andy, your first question. I've already 3 buy-to-let properties, but I've not been living in the UK. Will I be charged a surcharge relating to stamp duty if I buy a new property, which will be my place of residence, or will I be able to utilise the lower rates of stamp duty buying a personal property?
I guess the main sort of thrust of this question is the yet another stamp duty surcharge and rate to consider, which applies from the 1st of April 2021, which is for non-resident purchases of residential property. So in principle, if you enter into a transaction after that date and you are non-resident, then you have to pay a 2% surcharge, and that could be on top of the 3% surcharge for an additional rate property. So very easily, if you're buying a residential property as an individual and you're non-resident and it's at the top end of the value sort of spectrum, then you could be paying 17% stamp duty for having the temerity of buying a property in the UK. And to me, it's just absolutely bonkers. And if that added complexity wasn't enough, we also, within these new rules, we don't, when trying to determine whether somebody is non-resident or not, we don't look at the legislation that we already have in determining whether somebody's non-resident, so the statutory residence test. Oh no, this provision has its own unique residency test within it. So essentially you will be deemed to be UK resident, and if you're a UK resident, you don't pay the 2% surcharge, but you'd be UK resident if you were present in the UK on at least 183 days during any continuous period, and that period begins from essentially a year before you buy the property to a year afterwards. So if you are resident within the UK for a 183-day continuous period within that 2-year window, then you would be UK resident and wouldn't pay the 2% surcharge. If not, then you would have to pay it. And it's not just individuals that pay the additional 2%. Trusts and companies can, but they have their own residence test.
Andy, if you're taking that residency test over 2 years, i.e. the year before and the year during and after, at what point do you pay the stamp duty?
Well, it's a very good question, and I assume that let's say that 183-day period straddles the purchase. My understanding is that you would pay the surcharge and then you would have to recover it. So a bit like a scenario where you're paying the 3% additional surcharge, but then it becomes your main residence under the legislation, and you can then recover the surcharge from HMRC. Going back to the individual question, it's a matter of fact. So if they say they've not been living in the UK, you would just have to do that test. Do they satisfy that 183-day test? So have they been in the UK for that 183-day period? If not, then they're non-residents and they pay the surcharge.
How does that compare with the normal residency test then?
Well, it's even more.
Sorry, I'm just wondering what would happen if you failed one and passed the other.
I think it's more likely that you would be found to be non-resident, and again, I haven't really thought about this, but more likely that you would be non-resident under the statutory residency test, but could be resident for the purposes of this stamp duty test.
Okay, thank you. Cam, do you want to come in on any of that? Is that your field?
Well, I think Andy's explained it really well. All I would say is, as an entrepreneur perspective, is that, either scenario, think of it as cost of doing business, because it's all about one figure that we look at, which is ROCE, call it what you like, ROCE and so on, and working out that figure to find out if you're getting that return on investment. Are you getting that return on your cash? Of course, Andy's covered all the rest of it, but either way, really, if the property is making it work for you, then it's a good investment.
Okay. Andy, this isn't a scheduled question. It's just something I want to tack on in the light of our conversations about stamp duty. We saw in the week a couple of weeks ago in the news that Tesla, for instance, are now accepting Bitcoin for purchase of cars. Okay, and we've had many questions write in and say, can I use Bitcoin to buy property? How do Revenue treat that in terms of taxation either on profits or on value of your purchase. I mean, it's such a volatile currency. I mean, it'd make me worry to death. What happens if you calculate the value at exchange and then by completion, you know, Bitcoin's doubled or something? I don't know. What's your thoughts on that?
Yeah, I must admit, when you first started asking the question, I thought you were going to ask the question whether HMRC would let you pay your tax bills in Bitcoin for a moment. Although there is a canton in Switzerland which does accept Bitcoin to pay your tax liability. But bearing in mind that HMRC doesn't actually allow you to use a personal credit card anymore to pay your tax, I think it's probably a few years off. But in respect of your question, it's a good one. So let's say, and you can use it. I think this will be an issue with say Tesla's announcement. I suspect a lot of it's generate a bit of easy PR, really, isn't it? But let's say I've got £100,000. That's a bit much. How much is a Tesla? What, 50 grand? So we can go to the Tesla showroom. We can buy a car for 50 grand. So we've got 50 grand's worth of Bitcoin. So what's that? It's probably about 1.2 or 1.3 Bitcoin or something like that at the moment, isn't it? But if we then hand over our virtual currency for that car, that is a disposal of your Bitcoin. The conversion of your Bitcoin into fiat, so pounds or dollars or whatever, or into another cryptocurrency, is a disposal for capital gains tax purposes. So let's say our chap or chapess, they bought their Bitcoin around this time last year, about three and a half grand a coin. It's now worth, I don't know, about £35,000, something like that, per coin. So there's a lot of that will be capital gain, won't it? So they pay 20% on that. So the act of transferring that Bitcoin to their Tesla dealer will create an immediate capital gains tax charge, and it's something that they will have to be conscious of, because it's not, they're not going to get a reminder from anybody that they have to pay that capital gains tax. So if I was to enter that transaction today, 31st of March, so just before the end of the tax year, I would have to pay that capital gains tax over by the 31st of January 2022. So that is a problem of using Bitcoin as as a transactional currency. You mentioned the other one as well, Stephen, that Bitcoin used in that scenario. So the last time I became aware of it, it can take quite a while to clear, and therefore you do run the risk that the price will move against you, whether you're the consumer or the supplier, I suppose, in that interim period. And I think this is what a lot of the arguments against Bitcoin seem to be, that it's not, it really doesn't seem to be a very good form or medium of exchange. It's good for for sitting on and speculating and making money out of it, but that doesn't necessarily mean it makes a good medium of exchange, does it?
No.
So I've rambled on a bit there.
I just wonder if the current price of Bitcoin had anything to do with Mr. Musk buying $1.5 billion worth a few weeks ago. But there we are.
Absolutely, yeah.
All right. Okay, well, thank you. That's all we got time for in this half of the show. Join me again after the break. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin, and joining me are Kam Dovedi, welcome back Kam, and Andy Wood. Welcome back, Andy. Kam, your second question. I have entered the buy-to-let market and am ready now to purchase my second property. Naturally, the interest rate I pay on any loans affects my eventual yield. Other than taking out a fixed rate mortgage, are there any other ways of protecting my income stream for the future should interest rates rise significantly in the future? Wow.
First of all, congratulations for actually jumping in. So that's really good. In terms of what, in my experience, what we can do is you can actually create a system where you've got a no money in deal. So I'm not talking about no money down and all that kind of stuff. We're discussing here having none of your capital expenditure in that deal anymore. So that's returned back to you. So what you can do is a three-step approach to this. Okay. So first of all, you buy really well. That could be through estate agents or direct to vendor, or it could be auctions, whatever the method is. These are three methods in my experience that we use. So you buy really well, you're able to have some form of discount there. You then add value to that property. So that could be a refurbishment, that could actually be a bad tenant that you turn into a good tenant, because usually those people are disrespected and you respect them and they turn good. In my experience, usually anyway, and there's various other ways as well. So you are adding value to that property in whichever shape and form. Once you've done that, what you've now done is you've increased the value of that property. Where you've increased the value of that property in line with the values on that street, in that area. When valuers come in, they are now going to value that property at that higher level. So now you can refinance, and of course I'm not giving you any financial advice, but just sharing my experience, is that we're able to refinance at that top level. And when you refinance at the top level, when you do this correctly, you will find that every single penny of your capital expenditure is returned back to you. The key numbers are 33.33%. So 33.33% after all your costs, including capital expenditure, including the original investment, that can include mortgages and everything else, that's fine, finance. Then when you refinance at 75%, you will find that this works so well, where literally you have an investment. So if you're holding it, you're renting it, income's coming in. However, when you work out your return on investment, it actually works out to be infinite. So I'll get asked the question, well, are you saying, Cam, that you're making money out of thin air? Well, no, I'm not saying you're making money out of thin air. What I'm saying is you've got a system that allows you to actually create that same scenario where you are making money out of thin air.
You've created You've created a game process.
Yeah, absolutely.
Yeah, I see. Okay, that's very good. And what's your feeling on interest rates in the short to medium term?
My honest view is when all the experts are saying that the interest rates will never rise, they usually rise. That's what I say. That's my view. Hey, we've got some great times right now. The lowest rates that we've all had in our lifetimes since the Bank of England base rate started. So, we can't tell people what to do, but it's a case of, get on with it and really use this to the best of our advantages. That's what I say to people I care about. Get on with it and let's get this and use it before it's gone. Because we don't want to be that person who says, oh, I wish I did it then. I wish I did it back then.
Well, in a similar vein to other subjects that we've talked about in the various shows that we've had, again, if your business is dependent on a fixed rate interest and any fluctuation in that rate changes would affect your business dramatically, I just don't think you've got it right, have you? You need to build these factors in. And as you say, you suggested there a very positive step to creating a factual gain, not just a paper gain, but a factual gain.
A factual gain, because the equity is still there.
On the value of the property, and your equity is still in it at that level. You did just touch there that the valuers would value at the top end. How are you finding valuers at this time? I mean, being in sort of property development one way or another, I seem to have spent my life fighting with valuers. How are they treating COVID?
So what we're finding is that values are being conservative right now, and but there is flexibility. There's flexibility depending on the valuer as well, depending on the valuation company, depending on the lender. So there is some of that. However, whether the valuer values it at a lower price or whether they value it at a slightly higher price, when you think about the asset itself, it's a tangible asset. And the valuation, part of that is really on market sentiment.
Yes.
It really depends on the market sentiment. And as the market sentiment changes, values' opinions on the valuations will also change. But what we've got to remember is that we're working with the intrinsic value of a real asset, someone's home, a roof over their heads, a fundamental human need. So, the value intrinsically is always going to be there.
Okay, good. Thank you for that, Cam. That's a good answer. Thank you very much indeed. Andy, your final question. It's only 2 lines, but I think you might have quite a field day with this one. I'm in my 20s and I'm earning a decent salary. Could the panel suggest some alternative ways of investing in property other than in buy-to-let?
Oh wow, that's literally been let out of my cage into the big wide world, isn't it? And in terms of where we can go with this one, I mean, assuming by buy-to-let we're talking about sort of your I suppose typical sort of residential buy-to-let. I think there are a few ways that you can go here, aren't they? I think perhaps the obvious choice is commercial property, and I do confess, despite what I always say, that we shouldn't let tax drive the transaction, but that tax is all I know. So forgive me. I'm not that some of these may be terrible investment decisions, but I'll just loosely sort of describe maybe some of the tax pros and cons of particular routes. But so that first one is commercial property, and it is somewhat odd, isn't it, that the type of property that one invests in can have such a significant implication on how it's taxed. And again, one of the many sort of balmy elements of the UK tax system, really. And that if you're purchasing non-residential properties, commercial property, then you're automatically going to be paying lower rates of stamp duty, land tax, so you're reducing your transaction charges or costs of doing business. The likelihood is you'll be more in the game for things like capital allowances. So if you're buying, a commercial building, then they're probably going to be embedded plant and machinery in that property, which will qualify for tax relief, and of course the interest relief restrictions, so often referred to as sort of Para 24, Section 24. Those restrictions, again, don't apply to commercial property. So we don't have the danger of sort of phantom, a tax charge on phantom profits as we may have with a leveraged residential portfolio in an individual's name. So that's potentially of interest. If one is a bit more comfortable with sort of residential property, then you could look at things like holiday lettings, so furnished holiday lets. Again, the availability of tax relief for a furnished holiday let tends to be more so than you get from a normal sort of residential buy-to-let property. Things like net profits from furnished holiday lets are relevant earnings for pension purposes. Capital allowances, again, tend to be available for furnished holiday lets, whereas they're not for residential property. Capital gains tax reliefs, again, things like entrepreneurs relief can be available for a furnished holiday let, because the tax code for many purposes will treat a furnished holiday let as a trade. And then again, there's also another specific exclusion from those sort of pesky interest relief restrictions. There are a number of restrictions for furnished holiday let, so we can't just simply dress up our rundown terrace house in Warrington as a furnished holiday let by sticking in some sort of flyers for the local attractions. I'm not quite sure what the attractions would be in Warrington, but I can say that I live around here. So we have restrictions such as the property needs to be available and let on a commercial basis for at least 210 days in the year. And there's also a requirement that you actually let it, I think, for half that time, so 105 days, and we can't have a scenario where we've got people spending more than a month at a time in the property. It does need to be let on a sort of commercial holiday lettings basis.
Andy, I'm going to have to cut you short there. We're at the end of the show, but thank you for that answer. I think Andy, founder of ETC Tax, thank you for joining us today. Great contribution. Thank you. Kam Dovedi, thank you very much for joining us today. That's all we've got time for in today's show, so join me again next time on Property Question Time.